Good morning, everyone. My name is Bernard Agulhas from RiXForensica. Today, joining me is Philip Thomas, also from RiXForensica, and our special guest today is Bernard Agulhas, joining us for the topic today. Our topic today is fraud awareness. We're going to specifically look at financial investigations as part of the forensic investigation. We're going to focus on audits and specifically the role of an auditor. If you look at investigations and audits, Bernard, I think the role of an auditor, the statutory role, how an auditor should detect fraud, plays a very important role. What's your viewpoint on that?
Thanks, Rian. There's a lot of misperceptions around the role of the auditor, so it's quite important to clarify that from the start. The actual role of the auditor in terms of legislation is to express an opinion on financial statements, whether they fairly present or not. There's often an expectation that an auditor is meant to discover fraud as well. Auditors, on the other hand, believe that it's not their responsibility, but the standards actually require them to look for any factors that might indicate that there could be the existence of fraud, which means that they should look for fraud risk factors, and the standards are very clear on the areas in which they should look. So you can't say that it's not your responsibility. The auditor has to actually look for anything that indicates that there are circumstances which might indicate that fraud might exist. The auditor then has certain responsibilities, procedures to perform to ensure that if fraud does exist, that they can detect it, although they are not actually, the purpose of the audit is not to detect fraud, but it is still important that they find fraud if it does exist, because there might be some indicators to lead them into that direction.
During an investigation, we come across where we are doing the flow of funds as part of our investigation. And sometimes it boils down to you need to audit an audit that was done by an audit company. How does the flow of funds fit into that? Because then we do the investigation together with another auditor that understands the audit process. Is that flow of funds important at all for auditor to look at? And how does you then consider the fraud if you pick up there is an issue? Or
so an auditor won't necessarily compile the kinds of flow of funds that a forensic investigator would compile, because the objective of the forensic investigation would be different. It would actually be to look at the flow of funds. But an auditor, one of the important principles of an audit is that the auditor has to be skeptical at all times. So if there's anything that indicates that there could be a problem with the flow of funds, then the auditor could actually prepare working papers which might indicate that in that flow of funds process, funds flowed to maybe private entities or related parties, or any parties that it shouldn't have gone to. So the auditor doesn't go into the audit with procedures to specifically addressing the flow of funds. But there's nothing that stops the auditor from preparing a flow of funds and then seeing whether there's suspicion. If they have been sufficiently skeptical, if there's suspicions that something is wrong, can be confirmed by looking at those flow of funds. So it's not necessarily a requirement, but again, if those fraud risk factors are considered and there's anything that indicates that there could be fraud and that could be detected through looking at the flow of funds, then the auditor should have a look at it.
So I just want to talk about my experience with audits as well. So if we did an audit, we'll have a pre-planning audit planning meeting and we will discuss that there may be risk factors. But I think especially if we had a big audit, we beforehand you'll send the sample list to the client as well. So you'll get your sample list and all of the transaction invoices you need to test. So when you actually go to the client, you just go there to do the specific work. I think you do a more narrow view if you go to a client. Then rather than looking for it, because this is my list I need to check, and we will usually go to the client and we'll just do our checklist. I will say, as a first year, second year, third year, you don't have enough experience to actually look for fraud or what might pretend fraud. Because, for example, we had I was on one audit, and I was in my second year.
Sorry to interrupt you, Philip. You mean a financial audit, not a
Yes.
forensic audit.
No, financial audit. And I was in my second year of article, and there was, for example, a transaction on an invoice that I could not find. And with my inexperience, it was not a material amount. I think the invoice was like 200 Rand a month for every month. So in total, it was like something in the 2,000 Rand. And I kept on asking listener, where's this invoice? Where's this invoice? And end of the day, that client was so upset and said we were incompetent and all of this stuff. So I think as a clerk for auditing is sometimes you're so afraid of the client as well, and so you just do your tick list, almost like a routine checklist. That's all you do. You don't have the courage to go to a client and listen here, what is this or what is this, and to go the extra mile to look for something different. I think you will. Well, in my case, you were too scared about what a client will think, and your manager will say, listen here, this is your job. You need to find just these invoices. You need to make sure this is on the invoices and do that check. And for me as well, I think there's no auditing firm that does not have overtime that's working's done. I think there's so limited time to space in all of the audits as well. I think the time spent on the audit also needs to increase, because sometimes there's deadlines for certain audits. So you will work 2-3 weeks overtime the whole time, and you may miss stuff because you're working late, and the pressure is so on because there's always, according to I think all of the clerks, you're always understaffed. So you need to rush through the audit to get it finalized, and I think there's stuff getting missed as well with that.
Well, the first principle of an audit, and again, according to the standards, is that you should not accept an audit client if you don't have sufficient capacity, resources, meaning resources and time. If you don't have that, then you can't come back later and say that you didn't have enough time or you didn't have enough people. You can only accept that client if you know that you're going to have that. I know that what happens then is that you inevitably run out of time and you might not have sufficient people to do the work. But that can't be used as an excuse. You must make sure that you have the capacity before you take on the client. With respect to the first year clerks, most professions have opportunities or provide opportunities to first year students, first year clerks. A lot of them have students working with them for holidays. And that is to help them to get the practical experience. However, the standards also require that the partners and the managers have or perform sufficient direction, review, and they supervise the staff properly, they review their work properly, and they give them direction. So if your partner sends you in to do something, you have to go in after you have had a meeting with a partner or with your manager to give you the direction, to help you to understand what you are looking for. And again, from the start, it's important when I talk about professional skepticism, it is not something that you will maybe just start applying when you start working. You actually have to understand how it works, that you have to question everything, especially as a clerk, that you have to have a questioning mind, that you can't just trust everything that you see. So if a client gives you a piece of paper, you can't just blindly trust that piece of paper. You have to apply your mind to that. You have to be, it's not that you have to distrust everything, but you also just can't accept everything. But professional skepticism is created by the leadership. It comes from the top. If your partners in your firm, if the firm actually has a culture of questioning everything, of being skeptical, of not just accepting anything, then of course that will permeate down to the staff. So you might not walk into a client and know how to apply professional skepticism. It's something that you learn over time, especially as a first year clerk. But as a partner or as a senior person, you should know that the standards require you to question everything. You should teach your staff that they must, when they ask questions, what questions to ask, what to trust, what evidence they can use, what evidence they can rely on, because not all evidence are as reliable as the next. There's different types of reliance that you can place depending on the type of evidence that you are given.
So we usually had that saying, in God we trust, the rest we audit.
I would support that.
About the invoice. and you were looking for an invoice which you could not find, and now you mentioned the evidence. Now in your normal investigation work, you need to gather evidence because you use your evidence as facts to prove your investigation. So an auditor, I gather, also need to have evidence for the work that he has done. So if there's questions afterward that they can prove that this is the work that I've done and this is the evidence that I have.
Yes, in fact, in the auditing profession, audit evidence is quite important. There's a standard on audit evidence that specifically says that unless the auditor doesn't, let me just explain the difference between audit evidence and audit documentation. So audit documentation is the auditor has to write down the procedures that he or she follows and the work that they do. That has to be in their audit files. That's audit documentation. Unless that is there, it is assumed that it wasn't done. So an auditor can never say, I did speak to the manager and I did confirm the following. I did confirm with the bank that the balance is the same. You cannot say that. It has to be documented. When the auditor documents their procedures, they might gather evidence from the client. So they can look for the invoice. The invoice will be audit evidence. And that doesn't have to be on the file as long as the procedures that the auditor performed on that invoice is documented on the file. But there also has to be evidence to support that whatever procedures the auditor performs. The reason for that is that when the auditor, I mentioned at the beginning, that the primary responsibility is to express an opinion on the financial statements. The auditor cannot express an opinion if there is not sufficient audit work done or if the auditor didn't look at sufficient audit evidence. So it's similar to a forensic audit in that, and I think with forensic audit evidence is probably more important, but the auditor must support his or her opinion with the evidence that they have gathered. If there are no evidence, then the opinion from the auditor cannot be trusted or cannot be relied. We must remember that the auditor is not there to sell a product or a service. The auditor sells trust. So if the auditor signs off a set of financial statements, then anybody who relies on that set of financial statements must be able to say, I trust the information that is in there. And that trust is supported by the evidence on the audit files. The auditor cannot just say, I think the financial statements fairly present without the supporting documentation or the supporting evidence to confirm the auditor's opinion. And what happens mostly, and when fraud starts happening or when fraud happens, is when the auditor sometimes does not do sufficient work, or the auditor sometimes doesn't gather enough evidence, or they are not sufficiently skeptical to discover that there might have been fraud that they should have reported, because they still have some reporting responsibilities as well if they might discover that there could be fraud. But if the auditor says that the set of financial statements fairly present and there was, for example, fraud that occurred because of misappropriation of assets, clearly your assets are not complete. Or fraud could also occur because there is misrepresentation in the financial statements. And if a figure is misrepresented, for example, revenue is overstated, then it does not fairly present. So the auditor has a responsibility to gather evidence to support that information in the financial statements, so that when the auditor finally signs off to say they fairly present, it does. Or if the auditor signs off to say they do not fairly present, then there's also supporting evidence for that. Because the auditor can't just say, I can't express an opinion without performing the right procedures.
I just want to ask a question. I don't think there's any standard of this, but I've noticed now that also there's a lot of audit firms that do like a preliminary audit. For example, say the year end is in February, they'll do like a mini audit in the half of the year, and then when the financial year ends, they finalize audit as well. But I know some smaller audit firms only do the audit after the financial year. Don't you think that like a preliminary audit will suit better the conditions to pick up something? Because now you have in the half of the year you can maybe pick up something, and after the year end, if you do the final audit, there's another opportunity for you to look at all of the figures and stuff.
Whether an auditor does an interim audit or a final audit only depends on the audit approach. You can have it doesn't really make a difference. The reason they do interim audits is because sometimes the deadlines after year end are very tight. So if they have to report maybe 2-3 months after the year end, they cannot perform all the procedures after the year end. So they do some interim procedures. And then it doesn't mean that if you've done, the year end is December, for example, and you've done work in September, you don't just rely on that work blindly. You still have to see whether anything changed in those 3 months. So it is really just because the auditor might not have sufficient time to complete the audit before the deadline that they do that. And also it happens often when they can rely on the controls at the client, because then if the controls are operating earlier when they did the interim audit, if the controls are operating, and they place reliance thereon, then they don't have to do as much work after the year end as well. So I'm not sure if a financial audit, and you've got experience with both financial and forensic audit, so I don't know if the procedures are the same, Rian. When you do a forensic audit, are the procedures more focused on finding fraud, or I'm not quite sure how it compares to the financial audit. So financial audit is very focused on the financial statements, but clearly I can understand that a fraud investigator would look at the financial statements and look at the work that maybe the other auditor, the statutory auditor, has done and performed to help you to come to a conclusion whether there's fraud or not. So how does the fraud investigation work?
So the fraud investigation, we focus on the fraud to see whether there's any misrepresentations of the financial statements, how the financial statements is stated, but we also really rely on work that the auditor has done. You mentioned now about the evidence that is compiled and documented. So for us, if we do a flow of funds and we follow the money and we need to refer back, let's say for argument's sake, a company has been liquidated, to see what happened during when the audit was done, because we can clearly see the money was misrepresented, what it was supposed to be used for. Where do we find that evidence? Do we have to work through all the documents, or is there a simple point that you can only look at some evidence which will compile a summary of the work what was done? Something like, I know they refer to working papers. How important is working papers for us as investigators when we're busy with a forensic investigation, to get information from there?
So can I go before you? So I just want to add on because I have seen both sides. I think with a financial audit, you get the end product. So you get all of the financial statements, all of the trial balance, and all of the balance sheet items that recon and everything. So if we do a forensic audit, we have basic to and limited information. We start with bank statements. So we look much more of the flow of funds that I need to build to get to the end product. So where an auditor, you already receive the end product and you check if the end product is correct. Where if we do a financial audit or forensic audit, we only start with the bank statements and we need to build that product to match or to see what happens with the flow of funds and see if we can match the financial statements and see if there's any misrepresentation of revenue or expenses, just recording the flow of funds in the bank statements. I think we look much more in detail because we have that limited information and we need to build the product to the end, where financial audit, you get the end product and you can just test the controls and the amounts.
Yeah, if I was a forensic auditor and I wanted to rely on the financial audit, and of course remembering that the financial auditor, the statutory auditor, do not perform an audit for a forensic auditor to look at their working papers. They perform an audit so that creditors, investors, other stakeholders can rely on those financial statements to make financial decisions. And an auditor cannot be held accountable because somebody relied on financial statements for a purpose other than, for example, the auditor's obligation to express an opinion on those financial statements. Of course, there are some sections in the Act, in the Auditing Profession Act, that says that the auditor might be held liable under certain circumstances. For example, if they knew that somebody is going to rely on those financial statements. But generally, it's not so that forensic auditors can use those financial statements or the auditor's report. But the working papers that I would look for in a file, if I had to do a forensic auditor, audit and I obtain the files from the auditor, keeping in mind also that the auditing working papers are the auditor's property. You can get the evidence from the clients, but the working documents of the auditor, the working papers are the auditor's property. But say you can subpoena those working papers, the things that I would look for are, first of all, they have a responsibility to identify risks at the client. That's quite an important. It's the start of the audit. It's important that they get that right, because if they miss a risk, it means that they are not going to develop procedures to address that risk. When you express an opinion, the auditor has to gather evidence to be able to reduce any risk that the auditor identifies to a level where they can express an opinion. If the auditor can't reduce those risks, they cannot express an opinion, or they'll have to qualify their opinion. So it starts off with identifying the risks at the client. So I would look for those working papers. The standards also require that the auditor then has to respond to that risk by developing procedures to address that risk. So say, for example, the auditor suspects that there's a risk of fixed assets being misstated. That's a risk. And that is because there's an opportunity. One of the fraud risk factors could be that it's easy to steal assets in the company. That's a fraud risk factor. So that triggers to the auditor the fact that they need to identify that risk and respond to that risk. The auditor will then develop procedures to make sure that the assets that are there are complete, that they are fairly valued, that they exist, in fact. Those are called assertions. Each balance sheet and income statement item has certain assertions. For example, revenue must be complete. The cutoff must be there. It must relate to the current year. Those are the assertions that the auditor tests. So if you are doing a forensic investigation, you know what you are looking for. So if you are looking for maybe cash that has disappeared, or fixed assets that have disappeared, or revenue that hasn't been stated properly, then you will look for those specific working papers in the audit file to see what procedures the auditor had performed. So if the auditor had, for example, performed procedures on the completeness of revenue, then the auditor will make a conclusion to say revenue is stated. When the auditor says revenue is fairly stated, it means that it's complete, it's in the right period, etc., and then you can rely on that evidence. If the auditor, for example, says that the financial statements are qualified because revenue is not completely stated, then you know that there is a problem. But the auditor would not look for, well, maybe fraud is a bad example, because fraud is a presumed risk. There are certain things that the standards say the auditor must presume. Fraud in revenue is a presumed risk. Say, for example, the risk in fixed assets, that's not a presumed risk. But you start off with the risk identification, how the auditor responded to it, what work the auditor performed on that, but you will know exactly which accounts you have to look at. If you think that there's problems with the cash, then you'll probably look at the bank accounts. You won't find a flow of funds that you would normally prepare. But again, if the auditor identified that as a risk, there might be some procedures that the auditor already performed to respond to that fraud risk factor in cash, or the flow of funds where cash is involved.
So I just want to add. I think most of the public don't understand the different types of audits or financial statements you get. So, for example, we have investigations that is audit financial statements. We have that's compilation and that's independent review. But I think if you go out to the public, most of them are not sure that they don't even know there's a difference. They always think, no, it's audited financial statements. But I think it's also important that there's 3 different types of financial statements with different levels of assurance that's been given out. Because I think that one of the cases we had was, for example, it was just a compilation done, and the company was also in liquidation, and they have an inquiry about the loan accounts. So I think also there's a different assurance for just a normal compilation on what the third parties or public can rely on just on a compilation, and what does the independent review means, and what an audit financial statement is.
The importance between the different types of, I'll call it assurance services that can be provided. When you do an audit, it's assurance that's provided at the highest level. the auditor expresses an opinion. Also important then that there's only certain individuals that can perform certain of the assurance services. So an audit can only be performed by an auditor that is registered with the Independent Regulatory Board for Auditors. And that because that auditor expresses high assurance on which stakeholders rely to make financial decisions, investments, etc. So that is the one level. The second level is where an auditor can be asked to do a factual findings report. In that factual findings report, there's a clause that states that the distribution of those reports might be limited. And it's also procedures to do that factual findings report is agreed with they are agreed with the client. So it's not the auditor's prerogative to decide what to do. It's agreed with the client, and it's a limitation on the scope of what that auditor does. And a compilation agreement is where the auditor again just compiles information, and that can also be done by maybe somebody that's not an auditor, as long as you're an accountant and you understand and have the skills to be able to do that. So depending on what assurance is expressed, what level of assurance is expressed, where that information can be distributed, it also will then whether that information is restricted to certain people. Normally with a compilation agreement, it's for the client, it's not for outside parties. So maybe that must also be kept in mind when a forensic audit is done. First, look at what assurance was expressed and who expressed that assurance. If it's an auditor that expressed the assurance, then at least you know that auditor is regulated, must comply with standards, must comply with the code of ethics, and if the audit does anything wrong, then their regulator, the Independent Regulatory Board for Auditors, can take action against that auditor. Whereas none of the other role players or none of the other assurance providers are actually regulated in South Africa. So that's also a very important change that we hope to see, is that there would be regulation of all those financial players in the financial ecosystem, the role players, where you can trust us. If you come in and do a forensic audit and you know that you're relying on internal auditors, you're relying on what the CFO says, you're relying on all those that provided assurance, you can place reliance on them if they are regulated. At the moment, they're not. So if a CFO lies to you, if a CFO is unethical, you can't report them to anybody except maybe their professional body, but not to a regulator that can take their license away.
So if an auditor picks up there is a risk, and you know the risk, do we need to follow up to see whether they adhere to the risk that he mentioned, or suggestions he made to?
Well, again, the standards require the auditor cannot just identify a risk and leave it. They have to respond to that risk. They have to go and see whether that risk, when a risk is identified, it doesn't mean that something did go wrong. It means that something could go wrong, as with any risk register, where there's the potential and you look at the probability, etc. So the auditor has to respond, and the auditor might conclude there is a risk that fixed assets are misstated, but actually there's so much controls in place. The fixed assets, there's only 5 of them. I can count them, I can see them, they exist, I can look at their ownership papers. Actually that risk isn't there, and then the auditor doesn't have to perform that many procedures. But whatever response, a response could be that the auditor performs more or less procedures.
And if fraud is identified or possible fraud, where does the auditor report that to? Or where does the responsibility stop?
So it depends on what the auditor has discovered. In terms of the Auditing Profession Act, and this is quite an important provision for forensic investigators to keep in mind when they rely on auditors. Maybe also look for any reports on reportable irregularities. In terms of the Auditing Profession Act, the auditor has to report a reportable irregularity, and a reportable irregularity can arise. The definition includes 3 situations. A reportable irregularity will arise when maybe there's fraud or theft. So fraud is definitely in there. When the client did not comply with their fiduciary responsibilities to look after the the assets of the company, for example, they have fiduciary responsibilities to their stakeholders, or where there's any financial loss that has been suffered. But fraud is specifically highlighted as a reportable irregularity. Because there's confidentiality requirements in an audit, the audit can't just report that fraud to anybody or to the police. So that is to protect the confidentiality between the client and the auditor. However, Section 45 that deals with reportable irregularities allows the auditor to report it to the regulator, the Independent Regulatory Board for Auditors. And the regulator can then has the power in terms of the act reported to the police or to somebody else, to other regulators maybe. If it's money laundering, for example, then the auditor can report it to the regulator, and the regulator can report it to the Financial Intelligence Center, which is responsible for money laundering. So there are opportunities to report, for the auditor to report any fraud that's discovered. However, the auditor also might come across fraud that some actions that are more, it goes further than just fraud. And there's specific legislation that covers things like the POP, I don't know the full name, POC Tara, for example, looks at the financing of terrorist activities. That's one example. It then requires the auditor not to only go through the regulator, because now it's urgent and it's critical and people's lives might be at stake, and that allows the auditor, it gives the auditor the power to report it directly to the police. So if the auditor finds out that there's financing of terrorist activities, then the auditor reports that directly to the police, so the police can take action. So they don't have to go through the process of reporting it to the regulator and the regulator reporting it to the police. They can report directly. So there are quite a few powers that the auditor does have to ensure that fraud and other activities can be reported.
I think another question. So in our recent cases we had, most of the companies is in liquidation. So what I can see the trend in liquidation is, so for example, the company liquidated in 2020. 2-3 years prior to that liquidation, there was no financial statements. So I can see we have a lot of cases where there's an auditor that do the financial statements up till a certain end, and from there on, there's no financial statements ever done. And I don't think, I think there must be some kind of thing you can also mail to URBA or someone say, listen here, this client, I know there's clients that's financial statements is behind, but especially if it's like big clients. So most of this Ponzi scheme clients as well, the financial statements 2-3 years before they actually went into liquidation, there's no financial statements. But now the auditor does the financial statements, and then it becomes difficult to get all of the information, and the client's difficult, and then they just leave the audit. And then 2-3 years later, it's in liquidation.
Well, the auditor, if there's no financial statements, then the auditor cannot perform an audit, and the auditor can't prepare the financial statements that they will audit. So when there's no financial statements, then the auditor, there's nothing that the auditor can do. If it's a company, then the Companies Act requires financial statements to be produced so many months after the year end. So they will be in non-compliance with the Companies Act, and that company will be fined. And it could be that the company goes on for years without preparing financials. They have to submit them to the company's regulator, which is SUB-C, and if they don't, then they can be fined for that. An auditor should not ideally take on a client if they don't have financial statements. Or one of the risk factors that the auditor might look at is, were there financial statements? Was it difficult to get information about that client or from the client? That already indicates to the auditor that there's possibly risk involved. The standards also require the auditor, there's a standard on acceptance of clients, and it also cautions the auditor not to accept and take on a client if there is possible fraud involved, because you are just going to take on a difficult audit if you do that. They can do, nothing stops them, but it also should be a red flag. And to that company, if all auditors refuse to do that audit, then eventually that company must make sure that they change whatever is wrong, prepare the financial statements, make sure there is no misconduct in the company, get things right, operate properly, so that they can attract an auditor and get their financial statements. So there's no reporting responsibilities when a company doesn't, or an entity doesn't prepare financial statements, but you can only do that for so long. You have to get financial statements because those financial statements are relied on by banks to give you money, by creditors to provide you credit or to supply goods to you, and by other stakeholders to maybe invest in the company. If there's no financial statements, you can't actually do business. So if you know what the right thing is to do, you'll make sure that you have financial statements.
So, Bernard, on the Ponzi scheme, Philip mentioned, it's quite in the news the last few days. Ponzi schemes, where money is not invested where it was supposed to be invested. Is it the responsibility of an auditor, when he does an audit at an investment company, to look where the money is invested? How does the audit then start? Is it, I assume you don't have carte blanche, you can audit whatever you want to audit if you're an auditor and you go into a company. Does the client tell you what he wants to be audited? And can the client, in a way, if the client is busy with fraud and invest money in different companies or entities, keep it away from the auditor and say, you only focus for me on this part of the business, I want you to audit this? Or how can auditors be aware of simple things like Ponzi scheme in investment companies? What can they look for?
Okay, so firstly, the auditor cannot have any limitations placed on the audit, on the scope of the audit. The client has to give the auditor everything that the auditor asks for. The auditor, unfortunately, there are situations where the auditor might not pick up something, and it's when people collude. That's why segregation of duties is so important. Where people collude, for example, they work together to hide things, or management deliberately hides things, can still hide things from the auditor. The auditor cannot be held accountable for things that are hidden from the auditor. But that is why the auditor has to, so the auditor can ask for anything. The client might withhold some information. They might not tell the auditor about the Ponzi scheme. And again, that is why this requirement that the auditor must be skeptical. The auditor must be able to pick up any information that indicates that there could be a Ponzi scheme, and then ask the further questions. So they don't just audit what is in front of them. They have to look at what's in front of them and see from there if there's anything that leads them to ask further questions from the management. And the management has to answer them and give them what they need. Of course, they can say that the documentation doesn't exist. Eventually, if the auditor feels that they really needed this information to sign off on the audit report, to sign off the audit report on the financial statements, then the auditor will qualify the report. And no company wants a qualified audit report, because if any investor or a creditor or the bank picks up a qualified report, they know that there are issues. And that is why the auditor has to qualify that report if they don't get information. But with a Ponzi scheme, for example, I'd say that it's probably not that easy for an auditor to know that it exists, because the auditor doesn't go in to look for Ponzi schemes. But if there's anything, if the audit, maybe in fact, maybe there should be more guidance for auditors to look at what they should look for in a Ponzi scheme, because there's nothing that prevents the professional body and the regulator from issuing guidance to auditors to audit in certain industries. A Ponzi scheme is not an industry, but it certainly is a high-risk area that auditors should be aware of. And there's nothing that prevents the regulator from saying, yes, some guidance for auditors. Maybe there's an opportunity for the regulator to work with forensic investigators and say, what is it that what do you know, what do you look for when you do a forensic investigation into a Ponzi scheme? And if the auditor knows that that is what they could look for, that could also become a fraud risk factor.
Yeah, that's a very good point. Yeah. Any last remarks from you, Philip?
I think it's often difficult for there's not always understanding of the work that the auditor does, first of all. So I try to explain what the auditor's scope is and what the audit can be relied on and what they can't be relied on. But it's also important to note that an auditor cannot just throw their hands in the air and say, I missed this fraud, because they are required to perform procedures to see if fraud might exist. That is quite important. Often there's more reliance on what the auditor does than there should be, but at the same time, the auditor also has a responsibility and can be held liable, and claims could be instituted against an auditor if there is proof that the auditor was negligent, or if the auditor issued a report maliciously or fraudulently. The Act specifically says that. But if negligence can be proved, that the auditor knew that somebody was going to rely on those financial statements and then missed something because they did not respond to a risk, for example. If they don't have working papers to support their verification of fixed assets, for example. If they don't have working papers or evidence to prove what they have done on the audit. If that doesn't exist, then there is a case maybe for negligence. And if the auditor was negligent, there could be claims against that auditor in terms of the Act, especially when somebody was going to rely on the work of the auditor. And I think what I've seen where I've assisted with forensic investigations is, first thing we look at is to see if the auditor had done what the auditor was supposed to do. It's the auditor's prerogative. The auditor uses professional judgment to decide what they're going to do. Professional judgment means that because the audit is a profession, we can't question their judgment. I mean, unless they've missed something, obviously. But the auditor uses professional judgment, but you can still ensure that or confirm that the auditor has complied with the standards, the minimum requirements. And if the auditor did, then the auditor cannot be held liable. But if the auditor didn't, then there is a case that the auditor might be held liable. And again, it's not for the forensic investigator to decide. It's something that only the regulator can decide. So the regulator, that has to be reported to the audit regulator. They will perform their own investigation and then, if necessary, take it to disciplinary hearing. But it's up to them to decide whether an auditor has performed a proper audit or not.
Thank you very much, and thank you for joining us, Bernard. It was really very insightful, and I think it's important for us to understand the roles of a forensic investigator, especially as the role of an auditor, where it starts and where it ends. And yeah, as there's something in the audits where they mention that a company can be a going concern. I think fraud is always an ongoing concern, and it's each of us responsibilities to make sure that we combat fraud and we always be on the lookout, that we don't miss or overlook statements or our work to miss a fraudulent case or action, and make sure that we are always aware that fraud might happen.
Maybe the last statement from me, Rian, is forensic investigators have a specific responsibility to look for fraud and to find fraud. Auditors don't have that mandate, but auditors also should remember that as professionals, they are not only performing that service, delivering the audit to the company, they have a responsibility to the public. They are there to protect the public against fraud. They are there to protect the public against misconduct at clients. And if they keep in mind that ultimately, when they express an opinion, the public is going to rely on it. Other stakeholders will rely on it. And their primary responsibility is to protect the public. That is what any professional's responsibility is, not just forensic auditors or statutory auditors. Any other professional, they have a responsibility towards the public, doctors, nurses, teachers, lawyers, and often those professionals forget that that is their primary responsibility. So when an auditor does an audit and there's a possibility of fraud, the auditor would be really protecting the public if they can report on that fraud, if they do discover the fraud. So you don't just go in there so that you can sign off financial statements by saying that you've complied with the auditing standards and with the Auditing Profession Act. You also do an audit so that when you sign off on financial statements, knowing that others will rely on it, that you can protect them, that they can take assurance or obtain assurance from what the auditor has done, that the auditor has performed sufficient procedures so that they can rely on those financial statements. So we must always remember that the auditor still has a responsibility. The first responsibility is to protect the public.
Yeah, that's very true, and well said. Thank you very much.
Thanks, Ray.
Thank you.